All right, good afternoon, everyone. We're going to give it just a moment. Still got some folks joining, and then we'll get started. Okay, welcome, and thank you for joining us for the October session of our Community Associations Building Blocks webinar series. Today's session will cover the topic of how to retain financing for HOAs and COAs. I'm Jen Ritter-Smasick, Marketing Coordinator of Events and Proposals at Warden Smith, and I'll be your moderator this afternoon. If you have any questions with video or sound quality during the presentation, please reach out via the Zoom chat feature, and I'll try to troubleshoot with you. Our speaker today is happy to answer questions at the end of the presentation. If you have a question at any time during the presentation, please type it in the Q&A. So I'd like to welcome Justin Lewis, who's joining us today. Justin is a real estate attorney in our Wilmington office, whose practice experience includes a wide variety of residential and commercial real estate matters. And Justin, I'm going to turn the mic over to you and we can begin.
All right, thank you, Jen. I should mention we're going to go over basically loans for community associations today. And what I want to do at the beginning is just go over what I consider the basics. And then I should say we'll open it up to comments and questions after that. So I just want to start with why associations need to borrow money. It's usually for either repairs where what needs to be repaired is not covered by insurance, or the insurance is insufficient. See this, of course, with private roads, sidewalks, things like that. With condominiums, see it with the entire building, since the units are within the common element building. Sometimes the sidings, balconies, portions of buildings as opposed to the whole thing. We also see it with systems, HVAC systems, plumbing, electric, and sometimes it's a whole scale replacement. We see that a lot with roofs in both townhomes and condos, or replacement of amenity centers, clubhouse, pools, tennis courts, any other kind of recreational amenity that has either just deteriorated and there's not enough money in regular operating expenses or reserves, or it's something that's not covered by insurance. And we sometimes see it with new capital improvements, with building a new clubhouse, tennis court, some other recreational amenities, because this would be something that would not be, there would not be money in reserves for it. Obviously, insurance is not going to cover it, it'd be a new expense. So those are the typical reasons we see association need to borrow money. Although there certainly are some unique circumstances. So once the association decides it needs to borrow money, one of the decisions is, can we do it through reserves or assessments, or should we take out a loan? With reserves, if the reserves are sufficiently covered, if it's something that is typically covered by reserves, such as private roads or amenities, and the reserves are accurate, the amenity or road deteriorates when it was expected to, there may be enough for reserves. That's unfortunately often not the case, or in the case of building a new amenity, that's not something that reserves are maintained for. As far as assessments, there's always the choice to just increase the annual assessments. Boards can often do this without member approval. There's budget approval, but usually you can increase assessments line items in the budget. Or for older subdivisions, sometimes we'll see the board be able to increase assessments, say 5% or 10% without member approval. But even if that's done, it's not going to provide the association with a big amount of money immediately, which is usually what's needed for any kind of repair or replacement or new construction. There's also the special assessment, which can and sometimes is appropriate to use. That would result in one large intake of money, the same as getting a loan. The problem with that is, depending on the amount needed, if it's a large amount, say $20,000 per unit owner, that's going to be a big shock, and a lot of people simply won't be able to pay that at once. There's also the politics of it. You may need to get member approval, or if it's a community where you don't need member approval, the board has to make that tough decision to levy a big special assessment against the unit owners, which most boards do not like to do, but as directors, they're obligated to maintaining the common area in the community. And also, you might need member approval for this as well. And as I said, it's usually not very popular if it's a large assessment. So that leads us with a loan. Like with a special assessment, this allows you to get the funds you need immediately to address the repair, the replacement, or construct a new facility, but it'll be paid back over time. So the members don't get hit with a massive special assessment. Once you decided that you need to borrow money and that you want to go with a loan, you need to determine that you have the authority to do it. One of the things that you have to make sure you have the authority to do is basically enter into contracts and borrow money. 55A, which is covers all nonprofit associations, which pretty much all of our associations are. We'll occasionally see an unincorporated association. Has some basic provisions regarding powers of these types of associations, which includes the ability to purchase, acquire, otherwise just deal with real personal property, to mortgage or pledge its property, and also to make contracts and incur liabilities, make guarantees, specifically the power to borrow money and secure it with a mortgage or pledge of its property or income. So 55A probably provides most associations with all the authority they need to acquire property, enter into a contract, to borrow money, and to put up security for that money. In addition to that, if you're a planned community, either pre or post after 1999 for the 47F, you have the power to make contracts and incur liabilities and to assign its right to future income. Those same powers are covered in the 47C for condos and does apply retroactively. The other power you need is the power to actually levy and collect the assessments. Once again, 55A gives these types of associations the power to impose dues and assessments. 47F and 47C give the associations the authority to adopt budgets, collect assessments, and also the ability to enforce liens for unpaid assessments. In addition to those powers that are in the statutes, it's rare to see these powers not be included in the declaration of bylaws. The bylaws, or sometimes the articles, would cover the board's powers, which almost always is going to include specifically to adopt the budget, collect assessment, enforce liens, and also generally it'll reference all the powers under 55A or 47F or 47C. So the authority is usually pretty easy to find once you decide to go through with it. After that, the next big question or thing you need to determine is whether or not you're going to need member approval for the loan itself, to acquire property, if that's what you're doing, or to pledge association property. You typically do not need member approval to acquire property. That's a power the association typically has. But the documents, the specific documents for the community, can put restrictions and limitations on that. So that's something that needs to be checked. And also there typically is not member approval to simply borrow money, but once again, that's specific to each community. So it's something that has to be checked before going into this. If the loan will be secured by common elements, as in the real property, clubhouse, things like that, then you have to get approval of 80% of the members. It's 47F, and same thing for 47C. And if it's an older community or 47C doesn't apply, then it just depends on what's in the documents. And unfortunately, that's often not addressed. So you have to determine what level of member approval would be necessary. Fortunately, most loans to associations are not secured by the common elements. If instead the loan is going to be secured by the assessments, there's no statutory requirement for member approval, so it depends on the documents. If not, then you will not need member approval to enter the loan, borrow the money, and secure it with your accounts receivable if that's the requirement of the loan. As far as security goes, as I mentioned, common elements are sometimes used as security, but typically not. Just typically the common element owned by an association or owned by the owners of stamps and common in the condominium is going to be covered by the terms of the or encumbered by the terms of the declaration. All the owners may have use rights to it. So basically, it's not going to be of any real value to a lender if they've actually had to foreclose to enforce a default under the loan. And so because of that, the typical security is going to be the assessments or the accounts receivable as the bank would look at it. 90% of the time, that's going to be what a lender wants. And if it's possible, if you know, the loan is being used to replace or maybe repair some kind of system like HVAC or something like that, then you might see an association give a UCC financing statement in addition to the pledge of accounts receivable. Just before I move on, there have been a few examples I've had recently where this is kind of unusual, but an association has actually owned a unit either through foreclosure, and a bank has taken that as security. That's pretty unusual. Typically, if an association comes to ownership of a unit or a lot, the goal is to get rid of it very soon, usually not hold on to it pledge for a loan, but it is possible. As far as the loan structure, requirements, and documents, there's no one type of loan to community association. Typically, the term is shorter. We have occasionally seen the 20 to 30-year loan, but usually it's 5 to 10, maybe 15 years, which is good for the association. If it's something that gives you time to, especially if you're building something new, replacing something big, that would give you time to get it done and hopefully, you know, collect enough reserves so by the time it needs to be replaced or repaired again, there's no need for another loan. Typically, they're just regular monthly principal interest payments, fixed term or fixed rate over the term. Occasionally, we'll see more like a line of credit construction loan, where there'll be a 12 to 18 month period where money is borrowed, sometimes interest only, and it converts to a conventional loan. We just make principal and interest payments over the set term, which is, like I said, usually around 10 years. As far as lender requirements, they're going to make sure that the association is financially healthy. So you're going to have to provide a lot of documents, financial information, history of collecting assessments, delinquent payments. Probably need a copy of your collection policy. The bank will definitely consider the number of delinquent owners or the history of delinquent owners. They usually want to see, no more than 10% as far as the history of delinquent payments. They'll also look at the percentage of the units rented. While there's no, hard, set number, they usually don't want to see too many rented, usually 20, 30%. The way a bank looks at it, if, the more rental units, the harder it will be to collect. That's not always true, but that's certainly what the bank will consider. They'll also look at the balance in the reserve fund. If the association had enough money in the reserve fund to begin with, often the loan would not be necessary, but that does not mean that the bank will still not look to see if there's at least a history of maintaining reserve accounts and working toward having enough money to actually cover repair or replacement of capital improvements in the future. They're almost always going to require an opinion from the association's attorney. They require that. Basically, to let the lender know that the association does have the authority to enter into the loan, to borrow money, levy assessments. If member approval is required, we would opine that it was properly done and obtained. And occasionally, there is a vote to increase assessments or maybe some kind of special assessment, not for the whole amount, that would also need to be, we would need to opine on that in the opinion as well. There's usually be a pledge to include the debt service or the monthly loan payment as a line item budget in the association's budget. Want to make sure that part of that pledge is make sure that assessments are kept at a level necessary to cover the regular expenses of the association as well as the debt service. Usually they want to see a little bit of cushion, maybe 10% over what's required. You're almost always going to be required to open and maintain a bank account with the lender. This will also give the lender additional security. So they'll have security interest in the bank account itself. There's sometimes requirements that you will need to maintain the same management company for the term of the loan. Sometimes they even require that you maintain a relationship with the same professionals, CPAs or attorneys during the term of the loan. And there's almost always a prepayment penalty now. That doesn't mean you couldn't pay it off early. It just means if you paid it off through a refinance with another bank, there might be usually a 1 to 2% penalty of the amount of the loan paid off. And of course, different lenders have different requirements, but those are the typical requirements we see. As far as the loan documents themselves, it's usually not as complicated as some other commercial construction loans that we see. There's going to be a loan agreement, business term agreement, all different things. Basically, just lays out and explains the basic terms of the loan and the purpose of borrowing the money. There's going to be a promissory note, which is about the same as you see in any type of commercial loan. What'll be different as opposed to a deed of trust, which is secured by real property, you're going to see an assignment of rights to assessments. This gives the association, the lender, the ability to step in and collect assessments and enforce assessments if necessary. And as I mentioned earlier, sometimes there's a security agreement, UCC financing statement, if any of the property could be covered by that. If after you get into a loan, you go into default, one of the options, if there is a financing statement, a security agreement, the board or the lender can take possession of that equipment. More often than not, though, what they would do is essentially step into the shoes of the association and start collecting assessments directly from the members. And the way those assignments are written, they would have the power to also enforce the assessments through liens and possibly even lawsuits or foreclosure of those liens. So that is a brief summary of what I consider the most important points when considering to get a loan and once you obtain it, some of the requirements. But now I want to open up for questions if anyone has any.
Thank you so much, Justin. We haven't gotten any live questions, but we did have a few that were pre-submitted before the webinar. So I'll start going through those. And for those of you in attendance, if you do have any questions, please just type them in the Q&A box. And Justin is available this afternoon to answer those. So the first question is, can we get a loan to cover operating expenses?
The answer is no. That's not to say there's not a possibility. There's some bank out there that would do it, but it's unlikely since a bank wants to see that you're going to be collecting enough assessments to cover the debt service. And if part of the problem is you're not collecting enough assessments to maintain the common areas, pay insurance premiums, cover the basics, then you're probably not in a good position to borrow money from a bank. Also, if we were asked to advise on that, I think our advice under most circumstances would be, this is an example where you should raise assessments as opposed to seeking out a loan. Just raising monthly assessments or annual assessments would be the best solution in that circumstance.
And the second question is, can we get an SBA loan?
The answer is yes. We have seen SBA loans through community associations. I'm certainly not here to advertise for any type of loan or any certain bank. Lots of times SBA loans are favorable, lower interest rates, sometimes longer terms. The downside is sometimes they're a little more complicated. Some of the smaller local banks that are more used to dealing with loans made specifically for owners associations understand how owners associations work, how assessments work. Sometimes SBA loans, they get stuck in their own terms as far as what a special assessment is, what an assessment is, and it doesn't really match up with what that means to us. That is definitely not to deter anyone from seeking an SBA loan. Like I said, the terms can be very favorable. Just be prepared for a few extra steps if you take that route.
Great. And it looks like we do have a live question. I'm going to read through that for you. The first part is, we are a property owners association with only private roads, a small park, dam, and 4-acre lake as the association assets. We need to replace major portions of the road system. Can we get a loan secured by the annual assessment?
Yes, you should be able to do that. Obviously, I'm not the lender, and they will look at, like I said, your financial health of the community, things like that. But repairing a portion of the roads or any asset like that is something we typically see a loan used for. And like I said, likely for security instead of the property itself, they would want an interest in the assessments. So yes, that should be something you can get a loan for.
Thanks, Justin. And the final pre-submitted question is, can we give a discount on the amount of the assessment to members who pay early or in advance?
We get that a lot. Unfortunately, the answer is no. The assessments have to be levied equally. So there can't be a discount if someone's willing to pay early, pay in advance. The only way to do it is a little more complicated. You basically have to say, okay, the full assessment is due within the a date 6 months out. And then if people don't pay, you would have to treat it as a delinquent assessment, which means you have to file a claim to lien. And I mean, you could eventually reach a deal with people that pay later. But that setup, that method is not ideal. So unfortunately, understand the reason for wanting to do that, but the answer is no.
Thank you so much, Justin. I don't see any more live questions, but for those of you in attendance following today's webinar, we will send you an email with a list of articles related to the issues discussed today, a recording of the session, and a link to sign up for our community associations and real estate alerts. We appreciate you taking the time to join us today. Thank you so much again, Justin. And we hope you're able to take some of the information you learned today and apply it to your own organization. Thank you again. And that concludes today's webinar.
Thank you.